Welcome to Brain Vision.
In question 4, we're being asked to consider two policies: a tax cut that will last for only 1 year and a tax cut that is expected to be permanent. Which policy will stimulate greater spending by consumers, and which policy will have the greater impact on aggregate demand? Well, this is a rather simple question, and to answer it, let's consider a very simple and concrete example. Imagine that you're earning a monthly salary of, let's say, $3,000, and on average your disposable income is, let's say, $1,800. All right, so under the new tax cut, your new disposable income will be $2,000. That's an increase of $200 per month. So for this year, your disposable income would be $2,000, but because the government tax cut will be effective for 1 year only, from next year onwards your disposable income goes back to normal, which is $1,800. So, from your perspective as a consumer, the expected increase in disposable income will be equal to 200 per month times 12 months times only 1 year, which is equal to $2,400. Well, that's not too bad. You can use this extra money to buy some new clothes, go on a trip, buy a new guitar. And so this will definitely stimulate aggregate demand by a certain amount. Now, let's consider the same case but under a permanent tax cut. So the government announces a reduction in tax rates that would last indefinitely, maybe for 10 years, 20, 30, you name it. So from now on, your disposable income will be 2000, not just for this year, but for every year, for the next one, the one after, and so on and so forth. So in this case, from your perspective as a consumer, the expected increase in disposable income will be equal to 200 per month times 12 months times any number of years. Let's say 10 years. And this will be equal to $24,000 more, not just 2,400, right? If the increase is expected to last for more than 10 years, it would be 48,000 or 72, you name it. But we're talking about an increase that is larger by orders of magnitude than the other one. So what's going to happen with this extra amount of money? You're not only going to buy a guitar, you can buy a new car, you can renovate your house. So this will definitely increase government spending and stimulate aggregate demand by even more. So to sum up, we can say that a tax cut that is permanent will have a bigger impact on consumer spending and aggregate demand because consumers will view it as adding substantially to their financial resources and they will increase their spending substantially. On the other hand, if the tax cut is temporary, consumers will view it as adding just a little bit to their financial resources, so they will not increase spending as much.